Hello, everyone. Thank you so much for joining us today for today's webinar, AML 101 for Jewelers. I'm delighted to be joined here today by David Vegan of Outlier Compliance Group. Many, if not all, CJ members are dealers in precious metals and stones and have reporting obligations when it comes to anti-money laundering. One of those obligations is to provide training to staff annually. Today's training will focus on the AML basics, which can be used in addition to your own specific procedures to fulfill your training obligations that are outlined in the AML legislation and related guidance. Just a quick reminder that if you're using today's session to train your staff, you're also required to keep a record, which should include the names of all the people who attended, the date, and what was covered in the session. Now on to our presenter, David, who is the co-founder and CEO of Outlier Compliance Group, an anti-money laundering compliance expert and former banker. Outlier has been working with the CJA for over a decade, developing compliance resources, providing consulting services, and sharing their expertise with members through sessions like this one. Now, before I hand it over to David, I encourage you to put any questions you have in the Q&A section. We'll have a question period at the end of the presentation where we can address these questions, and all of the materials, including the recording, will be shared at the end. Everyone, please welcome David.
Thanks, Elena. Happy to be here like usual. We'll get started now. So, as Elena said, my name is David. I am co-founder and CEO of Outlier Compliance Group. Elena, we can go to the next slide. So a little bit about us. Outlier Compliance Group is a Canadian consulting firm founded in 2013. Essentially, our focus is helping reporting entities develop compliance solutions. This includes DPMSs, or dealers in precious metals and precious stones. Our solutions range from customized training, compliance program updates, examination support, effectiveness reviews, and other pieces. So if you have any compliance needs, feel free to reach out. Alana stated we've been partners for a very long time, just over a decade now, and we're happy to be here. We can go to the next slide, please. So a little bit of a disclaimer. We're going to be talking about the law today. I am not a lawyer, so anything I say should not be interpreted as legal advice. We're also going to be talking about one of our regulators, FINTRAC. I am not part of FINTRAC or any other government agency, so nothing that I say should be taken as an official government statement or position. If FINTRAC comes out with something tomorrow, please follow that, and you can ignore what I say if it says something different. We are going to have some time for questions at the end, but if there's any sensitive information or particular situations, I ask that you do not ask that in this forum. You can reach out to us and we'll try to help you out after. And lastly, we believe information should be free, so we're going to share a copy of these slides. As Alana said, if you are using this for training purposes, the material is only a part of it. You do need to keep appropriate records, so please ensure that you do that. We can go to the next slide, please. All right, so let's get started with some basics. The basics are going to sound very familiar for those that have attended before. Again, given that we are trying to make sure that this training is used for regulatory purposes, there has to be repetitive information, so bear with us if this sounds repetitive. We can get started, please. All right, so what is money laundering? Money laundering essentially is taking the proceeds from criminal activity and trying to disguise it and make it look legitimate, essentially washing the money. In Canada, the criminal code makes it an illegal offense to launder money, but also knowingly assist in that process. So under the Proceeds Crime, Money Laundering, and Terrorist Financing Act, which is the main act as it pertains to AML regulation, businesses have to take steps to ensure that their business is not being used to launder money. And if they suspect it, they must report to FINTRAC. We can go to the next slide, please. So how is money laundered? And here we're going to look at an example, but essentially you can think of it as having three stages. In the placement stage, criminal proceeds, which generally is cash, but not always, enter into the financial system. So here is an example specific to the DPMS sector. So this could be that the criminal is using cash or virtual currency to obtain or buy a gold bar. The next stage is layering, which essentially the criminal makes several transactions in order to separate the funds from the true crime. In this example, they may transfer the gold bar to a nominee, and then essentially that then gets sold. And then in the last stage, financial integration, which is essentially the clean money returning into our system. So the criminal would use that money from that gold bar that was sold to then purchase automobiles, houses, etc. We can go to the next slide, please. So, what is terrorism and terrorist financing? Terrorism itself is any attempt to influence or intimidate the government or public through means that usually are violent or create panic. Terrorist financing itself refers to the process of collecting, providing, and using funds and resources to support terrorist activities. Next slide, please. So what's the difference between the two? Essentially, you can look at it as, from a money laundering perspective, the funds always come from criminal activity. It enters those three stages that we just talked about, and the ultimate outcome is to make that the funds look legitimate. For terrorist financing, there could be criminal activities, but often there is legitimate activities in terms of where the funds are coming from. And the ultimate outcome there is to conduct or to do a act of terrorism. Let's go on to the next slide, please. So what is sanctions evasion? And this one is a little bit newer. The sanctions evasions requirement was introduced in mid 2024. And essentially here, it's an offense it's an offense related to the order of related to sanctions lists. So there's various sanctions lists, and we're going to talk about that in a second. But essentially, if you conduct transactions with listed persons or listed entities, you are conducting a sanctions violation, and that has to be reported. We can go to the next one, please. So what is a DPMS? Essentially, in Canada, precious metals and precious stones is a company person that buys precious metals and precious stones, jewelry for as part of their business activities. In Canada, you're subject to the obligation once you engage in purchase or sales of precious metals, precious stones in the amount of $10,000 or more in a single transaction. And for clarity, what that means here is precious metals are gold bars, gold, silver, palladium, platinum, things of that nature. Precious stones are sapphires, diamonds, emeralds. They include lab grown as well, which is important to note. So that is the definition there. As it relates to manufacturing activities, there is an exemption there. So if 90% of your purchases relate to manufacturing activities, you may be outside of the definition, but there is some nuance there. And often we see a lot of manufacturers actually fall within the scope of the regime. Next slide. So here's some common examples or questions that we get is, am I a DPMS? And essentially it goes back to that $10,000 definition that I just gave. And that's directly for your purchase of sales, but it's also for holding inventory, right? So if you've held inventory of $10,000 or more in precious metals or precious stones, you are likely captured. So in that first example, I don't accept cash, but I sell jewelry and watches. So it depends what the jewelry and watches are. If the jewelry and watches are made of precious metals and precious stones, and they've held $10,000 more in inventory, or they have purchases and sales of more than $10,000 or more, they would be captured. The next one, a traveling salesperson representing a watch company. They also have their own line of that they wholesale. So that second piece is what would probably get them captured. A traveling salesperson representing a watch company, the watch company would actually be the regulated entity. But because they have their own line and they wholesale to retailers, they might be captured there. The next one, I sell watches, some, not very many, contain precious metals and precious and sometimes diamonds. So likely they would be captured, even though it's not their norm. Once you cross that threshold again, I mainly do watch repairs. If you're doing watch repairs, you're probably not covered or fall within the regime. But what happens there, and sometimes we see, is people that or businesses that do jewelry repairs is they may actually sometimes buy unique pieces and then resell it, and that's where they may be captured. A manufacturer with some sales to friends and family. So I mentioned a 90% a kind of exemption in the previous slide. If they are selling to friends and family, they are likely to be caught. So yeah, we can go to the next slide, please. So who is FINTRAC, or what is FINTRAC? Essentially, FINTRAC, which is the Financial Transactions Report Analysis Center of Canada, is the agency that regulates our industry and ensures that we're meeting our obligation. They have a mandate to facilitate the detection, prevention, and deterrence of money laundering and terrorist financing activities, as well as sanctions evasions now, while ensuring that they protect personal information under its control. FINTRAC provides guidance, which essentially is to help us understand what the regulations and the associated act says. This guidance is related to how reporting should be done, how identification should be done, and basically all obligations they try to put out guidance on. It's important to note they're also our financial intelligence unit. And this is a very important piece because we have an obligation, as I mentioned earlier, if there's something suspicious, if we believe a transaction is related to money laundering or terrorist financing, we have to report that. And essentially, as Canada's financial intelligence unit, the agency takes that information that we're sending in and analyzes it and detects if there is a larger transaction pattern. And then this data is given over to law enforcement, which essentially then helps prosecute financial crimes and terrorist financing and money laundering. Next slide, please. FINTRAC examinations. Essentially, as part of their mandates, FINTRAC can examine any reporting entity at any time. Typically, it starts with a phone call. After that phone call, there is a formal letter. It is important to note that you have to comply legally. We get a lot of questions of, do I have to send this information? It's too much. We don't want to send it. You have a legal obligation to do so, and you're opening up yourself to risk if you do not. In the slide, you can see some examples of what might be examined, and examinations have changed a little bit over the years. We're starting to see more targeted exams, so not necessarily looking at your full compliance program, but parts of it. But within the DPMS sector, this is kind of the most common ones that we have seen over the years, or within the last year, I should say. So they're going to look at your compliance program. They're going to make sure that you are reporting all transactions that you need to report, that you're identifying clients and have processes in place for such when certain thresholds are met. And we'll talk about that a little bit later. You're keeping all the appropriate records. And there's obligations to conduct third-party determinations for certain transactions, which we'll talk about. That's also another piece that we are seeing in examinations. We can go to the next slide, please. Thank you. Within the last year, we're starting to see also what's known as assessment tools. So previously, FINTRAC examinations were the main method of how FINTRAC understood where you were with your compliance. We are starting to see more of these assessment tools, which are a lighter touch and a little bit less informal, but important to note they are the same. You have the obligation to comply with them. Within the dealer in precious metal and precious stone sector, we tend to see a lot of compliance self-attestations. And essentially, this is asking you questions about your policies and procedures, who created them, when were they updated. Well, and then the other one is called the supervisory risk questionnaire. I'm not sure if anybody here has received that one. That one's a little bit more involved. And essentially, they're looking at your overall risk. So there's a lot of questions related to where your customers are, where your transactions are, your actual internal risk assessment, and when was that updated and completed, and things of that nature. So we can go on to the next slide, please. So what happens if I don't comply? Essentially, FINTRAC has the right to issue fines and penalties. On this slide, we're talking mostly about criminal penalties, but if we actually go to the next slide, we're going to talk about AMPs, administrative monetary penalties. Administrative monetary penalties, I wanted to spend a little bit of time here because there has been an increased number of administrative monetary penalties across all the sectors. We actually saw some for the DPMS sector, which we hadn't seen in a while in the last year. As of March 2026, March 26th, 2026, AMPs have increased substantially, so 40 times. So here you can see in this chart something that is considered a very serious violation per instant can cost you up to $4 million. Um, this is a significant, increase over, sorry, $40 million, I should say. This is a significant increase over the past numbers. An example of a very serious violation is a suspicious transaction. So if you haven't reported a suspicious transaction, you're opening yourself up to significant fines. Now, the reality is it'll probably not hit that maximum number because there is calculation behind the scenes that takes into account your compliance history. It takes into account the harm done, so what information was being missed. A miss STR is very different than, an STR filed with some information missing. Um, Under the administrative monetary penalty regime, your name gets published, and there's also a list of the findings as part of that comes out. It's important to note that because outside of the fines, you have the reputational piece to consider. Reputational damage is something that, I think is top of mind for most companies nowadays, regardless of what sector you're in. The trickle-down effect is because this is public information, it can affect your banking relationships. It can affect your supplier relationships. So it's really something important to note. I mentioned that there were some recent fines. So in 2025, we saw two fines for the sector, one of $132,000 total and one for $264,000. The list of the bullet points were what the findings were at a high level across the two. A failure to develop and apply written compliance policies and procedures. The next one is related to your risk assessment. So failure to assess and document the risk assessment, failure to develop a written training plan, um, not doing an effectiveness review. And then the last one is related to suspicious transactions reports. Now, those particular ones, the development of policies and procedures, the risk assessment, and the training, as CJA members, I would hope that that never comes up. You have access to the AML toolkit where those pieces are given for free as part of your membership. You answer a series of questions and it produces that for you. The effectiveness review we'll talk a little bit about later, and the suspicious transactions we'll also talk about. So we're going to jump into the actual obligations now. And we can go to the next slide, please. So on this slide, this is the laws that govern essentially the AML regime in Canada. So as I mentioned earlier, we have the Proceeds Crime, Money Laundering, Terrorist Financing Act, and then associated regulations or enacted regulations under it. And then we have guidance from FINTRAC related to all of that. We also have the Criminal Code of Canada, ministerial directives, and sanctions. Ministerial directives, essentially, the Department of Finance can issue a directive on anything. That essentially in this, there's countermeasures to transactions coming from or going to certain jurisdictions. So this is something important to note, especially in the context of the DPMS sector. One of the more recent ones is Russia. So if you have transactions that are bound for Russia or coming in from Russia, there's some additional obligations that you have to do there. In particular, we know that Russia there's imports of certain pieces there, so importing Russian diamonds as an equivalent. There's special measures there around what is allowed and what is not allowed. Next slide, please. Sanctions evasions. So I talked to this one a little bit earlier. Back in August 2024, essentially there was the longstanding obligation to report transactions where there's reasonable grounds to suspect that there's money laundering and terrorist financing. But as of August 2024, the obligation also came in related to sanctions evasions. Now, Canadian sanctions essentially is a restriction on the activities that are permissible for persons in Canada and outside of Canada for foreign states, individuals, and entities on the lists that are named there. These persons may attempt to conduct transactions, and if they do, we have a reporting obligation. The reporting obligation is if you have funds from the customer that is on the list, but also if you have property. And that's important. So an example is maybe you're holding a gold bar for someone that's on the list. You would have a reporting obligation as there as well. Related to sanctions evasions also, there's the larger sanctions obligation, and this is actually something that applies to most businesses in Canada. It's not specific for the DPMS sector, but we need to monitor and report relevant property ownership, exporting and importing of goods in connection to sanctioned individuals or entities. There's a list on global affairs websites of the particular countries that we can and cannot conduct certain types of transactions with. And then the list here is related to the sanctioned individuals and the sanctioned entities. Next slide, please. So your responsibility under Canadian law. Essentially here, you have to have a compliance program in place. There's 5 pillars, if you will, related to it. So you must have a compliance officer in place responsible for your AML program. You must have policies and procedures that outline what your obligations are and how you are doing that. A risk assessment considers how the business can be used to launder money, but then all the controls that you have in place that mitigate and prevent that from happening. A compliance effectiveness review is an independent audit, if you will, against your program to ensure that you're meeting your obligations. This must be done every 2 years, and it must consider your program, but also your operational piece. Very often we see it cover a compliance program, but it doesn't look at the operational piece. And if it doesn't, you're not meeting your obligations. And then lastly, training. You have an obligation to have training as well as a training plan. As we mentioned, this can be used for training so long as you keep the appropriate records for it. From an operational perspective, there's a list there. You have certain obligations that you have to, or certain types of transactions that have to be reported to FINTRAC. Record keeping, you must keep records for most things as it relates to your AML program and operations. Identifying customers at certain thresholds, which we'll talk about later. Customer risk and risk rating and transaction monitoring. And this is very specific to customers that meet the definition of a business relationship, and we'll get into what that means later on. Next slide, please. Keeping your compliance program up to date. So here's a list of when and how often you need to look at your elements of your program. So compliance officer appointment, only when there's a change that needs to be an appointment. This is something that we see quite often, especially at smaller shops. There isn't an official appointment. This could be as simple as a note, but there should be something formally documented that has the compliance officer appointment. Policies and procedures, risk assessment, and training are all annual, so they must be reviewed. Even if there are no updates, the obligation is there to review it, and there should be a record of the review. Effectiveness reviews, as I mentioned on the last slide, have to happen every 2 years under obligations. You may have suppliers or banking relationships that require that more often. So the effectiveness review. Compliance effectiveness reviews um, happen every 2 years and have to test your operations and compliance program, as I mentioned. The purpose is to assess if your compliance program has gaps and weaknesses, but it also must test the effectiveness of your compliance program. Um, there's been some regulatory change and there's going to be quite a bit of focus on that. So I want to make sure that that piece is stated here. Your review must be conducted by someone that has AML knowledge. That's very important to note. It can't just be a junior staff that doesn't know the requirements. It must be independent as well. So somebody that is involved in your compliance operations, such as your compliance officer, should not be the one doing your effectiveness review. Um, your bank, and we're starting to see more of this more and more, is starting to ask for evidence of this. So they're actually asking for the report with a list of the observations and the credentials and the methodology related to the effectiveness review. Next slide, please. Record keeping and reporting. So all records that have to be maintained under this regime must be maintained for 5 years. If you're not sure if a document should be kept or destroyed, please ask your compliance officer if you do not have an internal retention policy. We also have things that we have to report to FINTRAC, and we'll get into the timing related to those shortly. Those records of whatever we report to FINTRAC must also be kept for 5 years. Next slide. FINTRAC reporting. I think I've covered most of this already. So some transactions might require additional information as part of reporting. So it's important to work with your compliance officer if they're asking you to go back and ask and gather additional information from the customer. All transactions that have to be reported, you have to identify the customer, and we're going to go into the method shortly. With the exception of suspicious transactions, you have the obligation there to try to identify the customer. But if you're going to be tipping them off, then we don't do that. And we'll talk a little bit more about that in a second. So these are the reports or the types of reports that have to be submitted to FINTRAC by the DPMS sector. So large cash transactions, if you take a cash payment of $10,000 or more, that has to be reported. Large virtual currency, that has to be reported within 5 days. And this is if you take payment as virtual currency for product and service. Suspicious and attempted suspicious transactions have to be reported as soon as practicable after completing the investigation that helped determine if there were reasonable grounds to suspect that the transaction is connected to money laundering or terrorist financing. And lastly, listed person or entity property reports. This was previously called terrorist property reports. It changed in relation to the sanctions evasion piece, which we talked to earlier. That has to be reported immediately to FINTRAC, but also the RCMP and CSIS. Next slide. So large cash. The large cash transactions, as I mentioned, is $10,000 or more in a single transaction or multiple transactions within a 24-hour window. This is cash in any currency, but it does mean physical bills and coins. It is not a check, it is not a money order, it is physical cash, regardless of currency. Um, you must identify a customer before you complete a large cash transaction. So if a customer comes into the store and says they forgot their ID, but wants to pay in cash, you cannot conduct that transaction. It is okay to tell the customer you are collecting additional information because you have to fill out a large cash transaction report. Um, that is perfectly fine. Sometimes it helps the transaction go smoother. One thing I wanted to bring up here is for stores that have multiple locations, you must have a mechanism in place to monitor between the stores. So if I, David Vijan, go into store A and buy something for $5,000, and later that evening I go into a second location that you have and I buy something for $5,000, that is two transactions related to me within a 24-hour window, and that must be reported. This is something that I think can be a little bit complicated because essentially you need to have some sort of connection, either name or phone number, between systems that is going to allow for that type of monitoring. Let's go on to the next. Thank you. So large virtual currency, it's very similar. Large virtual currency in this instance, we're talking about Bitcoin, Ether, things of that nature. So if you're taking that as payment, there are reporting obligations the same as cash. So one transaction of $10,000 or multiple transactions that equate to $10,000 in a 24-hour window. Next slide, please. So I talked about this already, but essentially 24-hour window is conducted by the same person or entity or on behalf of somebody, and that kind of connects to third parties, and we'll talk about that later. For clarity, when we're talking about third parties, this essentially is someone instructing a customer to complete a transaction. Um, on their behalf. This is not meant to capture uh, my fiance picked out the ring and I'm just buying it for her, or my mother picked out this necklace and I'm buying it for her birthday gift. It's not meant to capture those. It's meant to capture a certain friend or a friend of a friend couldn't come into the store and wanted me to pick up this Rolex today. Um, in those instances, we must collect certain information related to the third party, not only the individual that is in front of you. Next slide, please. So unusual transactions. So if you have reasonable grounds to suspect that a transaction is related to money laundering or terrorist financing, you must identify the customer and then escalate that to compliance, where they would make a determination if something needs to be reported as a suspicious transaction to FINTRAC or not. Important things to note, there is no dollar value associated with it, so there's no de minimis exemption. It could be a $20 transaction. If you think it's suspicious, you have to escalate. I think there's a misconception that transactions only relate to cash. It doesn't have to be. If there's something suspicious and they paid with a credit card, that is still something that gets escalated. Even if the transaction is not completed, so somebody comes in, it's a very suspicious interaction, but they leave. They don't actually buy the thing. But you've gathered basic information in the context of that conversation that still should be escalated to compliance, and they will determine if something needs to be reported or not. Unlike cash and large virtual currency, you cannot tell the customer you're suspicious of them. It's called tipping off, and that's something we don't want to do. Is tip the customer off. The stages of suspicion. So the stages of suspicion here, simple suspicion, this is kind of just a hunch. Um, Something's a little bit off. Reasonable grounds to suspect is where you have an obligation to submit an STR to FINTRAC. Reasonable grounds to believe, this is a step above, and you definitely have an obligation to report there. So the reasonable grounds to believe is somebody maybe explicitly states that the funds come from a criminal source. I sold a bunch of drugs and I'm buying this gold chain or something of that nature would be an example of that reasonable grounds to believe. Um, Really, the gut feeling is where you want to escalate to your compliance officer. If something just doesn't seem right, if something seems off based off of your interaction and what you know about the customer, report that to the compliance officer. It may look a little bit different in your organization. It may go to a manager, and then the manager reports to the compliance officer. So just be sure you consult your internal policies and procedures. But what I'm getting at is it's something that should be reported. Next slide, please. So, what indicators should I look for in customer behavior? Here's the reality there's no single behavior that's going to be the same at any time. Trust your instincts, and if in doubt, just file with the compliance officer. Some people may get very aggressive with you, but the reality is a lot of them won't. They'll actually try to be your best friend because they're trying to win your trust, right? So I think there's a misconception there of, oh, a criminal is going to be a big, scary bad guy. And the reality is it's not always the case. Next slide, please. So what indicators should I look for in a transaction? Um, Basically, is something unusual about this transaction given what I know about the customer? Does the transaction make sense based off of the conversation? They're a part-time salesperson at Starbucks, but they're buying a $50,000 Rolex with cash. Does that make sense at surface? No. But maybe you have a deeper conversation. The money came from a gift, as an example. So again, really what the indicators are may look different. Trust your instinct and escalate if you feel something is off. Here's some examples of common ones that we do see. And this is definitely something you want to escalate to your compliance officer. So the customer changes their mind or changes the amount that they want to pay with cash because you said you had to collect identification. That could be a potential structuring to avoid identification. So you would want to escalate that. The customer refuses to be identified. That is something you want to escalate as well. The customer makes several payments in cash using or prepaid cards. Um, that in itself is usually suspicious. A customer tells you that they're paying for the item with the proceeds of crime. Criminals sometimes like to boast, and that is definitely one that we've seen and you should be escalating internally. Next slide, please. Listed person or entity property reports. This ties into the sanctions piece that I spoke about earlier. So if you're conducting transactions with persons on a list, if they're a listed person or listed entity, you must file a listed person property or entity property report with FINTRAC. You must also file a suspicious transaction. So that is, again, something that's newer, but an obligation for the DPMS sector. Next slide, please. I think I've already talked about this in terms of sending reports to the compliance officer. Um, Important to note that your escalation to the compliance officer needs to be timely. So you should be reporting to the compliance officer immediately. And essentially, this is to make sure that they hit the specific timelines that are needed for reporting transactions to FINTRAC. If an entity is off the reporting timelines, they're potentially opening up themselves for a fine. And remember, you're protected. So as long as you escalate to the compliance officer in good faith, you're going to be protected under Canadian law. The reality is we're going to file an STR and we're probably not going to hear about it. The reporting entities don't hear back. The chances of you having to go to court are probably very slim. This is the reality, but as long as you are doing in good faith, you are protected under Canadian law. One thing I wanted to note here, CBSA declaration requirements, importing and exporting. This is a newer requirement that came into place in 2025. And while it is not specifically under our main, the Proceeds Crime Money Laundering Terrorist Financing Act, it is connected to money laundering. So anybody that imports or exports goods, so if you're importing diamonds, gold, etc., you do have to make a declaration with CBSA to state that the goods are not connected to money laundering or terrorist financing activity, which means you need to be doing due diligence in the background. This requirement essentially came in to mitigate some of the risk related to trade-based money laundering, and there's some examples there related to what trade-based money laundering is specifically. Next slide, please. All right, we're gonna get into identification now. We can go to the next slide. So, as a dealer in precious metal and precious stones, you're responsible for identifying customers in the instances that are listed there, which is large cash transactions, large virtual currency transactions, and suspicious transactions. When you identify a customer, you must be sure to record all information that is required under law. It's not good enough to just check an ID and say, okay, we must keep records of it. If a customer is a company, you must identify the company, but you also have to collect information on the beneficial owners, and the person that's the signing authority would go through the same identification process as an individual. And we're going to get into that now. So we can go to the next slide, please. The government issued photo identification is going to be the most common, I think, for this audience. Essentially, you must use a government issued photo identification document that meets the standards listed in the bullet point there. The most important piece is that it must be authentic, valid, and current. There's information that you do have to record related to this, which is name, address, things of that nature. You must also record the issuing jurisdiction, so where it was issued, including the country, and the expiry date for the document as well. There's an obligation to essentially authenticate the document. Now, when a person's in front of you in store, it's fairly easy. You can look at the documents and check the security features on the government issued photo identification document. But what do you do in cases where the person is remote? In remote situations, you would have to have software that did that for you. Next one, please. Provincial health cards. We get this a lot. Can I accept a health card as government photo identification? In certain provinces, you can, but there's usually legislation outside of the AML regime that restricts what can be done with provincial health cards. So to be safe, make sure you're checking what provinces it is allowed in and what provinces it's not allowed in. Typically, your go-to or safest is always going to be a driver's license or a passport. Next slide, please. These are other methods that you can use to identify a customer. So in that instance that I gave of, the customer is remote, you could use a credit file method. So if they have Canadian credit, they would have a credit file, and you can use that method. And I'm not going to spend too much time into what that is. That would be well documented in your AML toolkit if you do use that method, as well as FINTRAC's website. The dual process method, we do see this one from time to time, but essentially you must match a combination of the following in that second category there. So name and address, name and date of birth, or name and Canadian financial institution. So essentially the customer has to have an account with a financial institution. You could also use an agent or mandatory to check photo identification on your behalf. You do have to have a written agreement in place in order to do that. Next slide. Organizations, as I mentioned earlier, you do have to collect information related to the organization itself, but you do need to collect information related to the people who own the business as well. They're referred to as beneficial owners. You do have to identify the signing authority as well. That's not on the slide, but I mentioned that earlier. Um, there's an obligation to keep a record if the customer is a not-for-profit, so you do need to ask them if they are not-for-profit. Next, please. Beneficial ownership discrepancy reporting. So this is a new requirement that came in late last year. So in those instances where you have customers that are entities that are customers and you have the obligation to identify them, if they are considered high risk and you notice a discrepancy with the Corporations Canada database, so you've collected information from the customer, but now you're going to confirm information and it's not exactly the same. If this customer is considered high risk for you, you have an obligation to report that discrepancy within 30 days. Um, so keep that in mind. Um, the last bullet point is what I'm stressing here is it only relates to if the customer has been deemed high risk. So what happens when identification fails? So you have, obligations, as we stated, with large cash, large virtual currency, suspicious transactions, listed persons, and property. What happens if you can't identify the customer? In certain instances, you cannot conduct the transactions. So no large cash or large virtual currency transactions should be performed. There's no exceptions to this rule. If you do, you are offside the law. Suspicious transactions, as I mentioned, you have an obligation to try to identify. Um, if it's just a suspicious transaction, you try to identify, but you feel like that's going to be tipping off, you still file the STR with the information that is known about the customer based off of the interaction. Business relationships. So I mentioned this term earlier. It is a bit of a tricky term. Business relationships are customers where you've conducted two or more activities that require identification within a 5-year period. So the most common examples is going to be David Vigen came in and conducted two large cash transactions within a 5-year period. It could also be in a case somebody is paying with large cash, but that transaction is suspicious. So you file an STR. The STR is considered one activity and the large cash transaction is considered one activity, so they're considered a business relationship. When you have a business relationship with a customer, you have additional obligations, which include monitoring, risk rating, but you also have to collect the nature and the purpose of why they are doing business with you. A common example for this is going to be purchasing jewelry for personal enjoyment. When you do have that business relationship, you have an obligation to do what is known as politically exposed foreign persons or head of international organization determinations. If they are a foreign PEP, they are considered high risk. If they're domestic, you can do a risk assessment to determine if that customer is high risk or not. The easiest way is asking a customer at the time of a transaction to do this. But if you have software and screening in the background, this can be done. This is very commonly screened with sanctions, as an example. And here's a list of, some examples of who a foreign PEP would be. We don't need to spend much time there, but those are some examples. The next slide talks about some examples of domestic PEPs. And then the next slide talks about the head of international organizations and what they particularly are. Then just being mindful of time, we're going to get into some additional considerations and changes. So let's get into some upcoming changes. As of March 26, related to the higher AMPs or administrative monetary penalties, as part of that legislative amendment, there were two other pieces that I wanted to note here specifically for the DPMS sector to be aware of. I mentioned this earlier, so the effectiveness. So your AML program, when FINTRAC comes in to do an assessment, is now going to be looking at how effective your compliance program is. And this is a shift from just technical compliance in the past, where it would be, oh, you have a list of the requirements, you have a list of the processes, you're good. They are going to be looking at the sophistication of your program based off of your size, based off of your risk model. They are likely going to be comparing it to other similar entities in the background. We haven't seen guidance on this yet, and I think it's going to be some time, but this requirement is actually in force already as of that March 2026 date. The one below it, uh, thanks. So the one below it is related to FINTRAC enrollment. This is a new requirement. And this is not just specific for the DPMS sector. This is specific for all reporting entities. So currently under the AML regime, money service businesses are the only entities that have to register formally with FINTRAC. This is outside of registering for your reporting system. This is registration related to, hey, I am a regulated entity and this is my products and services offering. We're not exactly sure what this looks like, but essentially there will be a public registry and a list of all reporting entities with basic information. DPMSs will have to register with FINTRAC and ensure that they're keeping information up to date. The CGA has been involved and has raised concerns, particularly around if address is going to be shown from a privacy perspective. The hope is that it wouldn't be, there would be an address for service, and that would be the public information. As we know, some jewelers may operate outside of their house. So we have raised concerns, or the CGA has raised concerns, but we are waiting draft regulations. We expect it to happen probably June or July, and we're not sure what the transition period will look like, but there will be communication from the CGA as we learn more. So something to keep an eye on and watch out for in the coming months. Next slide, please. De-risking. So we've gotten a lot of inquiries last year and kind of even started in 2024. Can my bank close my account without warning? Yes, they can. A bank can close your account without any warning. Typically, what we've seen is there is warning. The banks are usually asking for the DPMS sector to provide policies and procedures related to their AML program, to complete questionnaires related to their framework, or sometimes to provide their copies of compliance effectiveness reviews. If you're not responding to those timely, if you're not sure how to respond, you're opening yourself up to risk of the bank potentially closing up your bank account. We are seeing this more and more. So, as a recommendation, you should always have a backup account or alternative. Once your account is closed at one bank, it is harder to get a bank at another. So please keep that in mind. If they are asking for something, you do need to respond timely. If you're not sure how to respond, you can reach out to us and we'll try to help. Canada's mutual evaluation. We talked about this one last year. We've completed all our interviews and we're essentially waiting for our draft report to see how well Canada has done as a nation in relation to its AML regime in comparison to the global scale. We expect that in June, I believe. There will likely be amendments to our regime as a result of that. We're not sure exactly what they will be, but if there are ones that relate to the DPMS sector specifically, we would obviously make the changes to the AML toolkit and there would be communication from the CGA. And with that, I think we have 5 minutes left for some questions. So maybe we can stop the recording and head to that, please.
Thank you so much, David. As always, so much great information that you share with us and keeping us up to date.